And here we are again. This time we're doing GPT. Can GPT, can they beat the Series 7? I'm going to do 50 questions. It should be about 50 questions. We'll put them in there. I'll throw them in the chat. We'll see what they say. And we'll learn a little bit as we go. And we'll see if GPT can actually beat the 7. And it kicked my ass with the SIE the last week or 2 weeks ago. So let's try a new one. Okay, so the way we're doing this is we're going to run the question. I'll read it to you. Then we're going to let GPT answer it. And if they're wrong, I'll try to correct them. And if you want to learn from this, please, when you see the question, hit pause, answer it yourself, and then hear how I do. Now, remember, wait till I explain what the GPT did, because sometimes they're wrong. Okay. Not a lot. They'll probably be pretty good. But just remember, they're wrong sometimes. Go wait for me to fix it. And then we go from there. Everyone, let's get going, baby. Let's get into this shit. What is the current yield? I'm going to put it in the thing. Boom. What is the current yield on a U.S. government bond with an 8.5% coupon trading at 101.8? Let's see how they do it. So they're going to say the answer is C. So let's see how it is. Current yield, annual interest over market price. True, 8.5% apart, 85. They have it 101.8% apart, 1,018. I think they made a mistake there. Okay. So now let's correct them. Let's say, so they're saying it's C, but and it's B, but let's go into this. But I'll use voice. So this is a treasury, so it's traded out of 30 seconds. So maybe you want to give that a new shot. Good catch. You're right, Ken. Of course, you never have to say me I'm right. I'm always right. Treasuries quote in points in 30 seconds, not simple decimals. So let's treat that 108 properly as 101 in 830 seconds. Here's the math right the right way. 101 plus 830 seconds is 101.25 because you do 8 divided by 32. It's 1,012.50. Annual interest is 8.5% apart, 85 bucks. Current yield is 85 divided by 1,012.50, 0.0839, which is 8.39%. Boom. Okay. And the reasoning, that little 0.8 wasn't 0.8%. It was 830 seconds. A clash, a treasury trap. Slightly above par, knocks your yield just a hair below the coupon. And there we go. So the answer is B as in boy. That's one wrong. I'm going to say that. Keep a tally. That's one wrong. Okay. Scoreboard up. Correct 0, wrong 1. Fire away with question number 2. Here we go. There's a longer one. Let me put it in there while I read it. A company offers $10 million of 8% 20-year debentures. Each debenture is convertible to common stock at 50. The bondholder needs to liquidate 10 convertible debentures. The market price of the bond is 102, and the market value of the common stock is 53 buckaroonies. Which of the following actions should the bondholder take? A, sell the debenture. B, tender the bond to the company. C, where are we? Convert the bond and sell the common stock in the market. Convert the bond and tender the common stock to the company. So I got to take that back up because I copied way too much. Here we go. And let's go, baby. All right, here's how we size this up. Step 1, figure out what the conversion gives you. Par divided by 50. 1,000 divided by 50 gives you 20 shares. I like that. 2, what'd you get? If you sell the bond, you get 1,020 since it's 1,002. If you convert, you get 20 shares. So conversion is a better play. That's cocky too. You convert the bond and sell the stock in the market. That's how you lock in the higher value. Answer, convert the bond and sell the common stock in the market. Reasoning, always chase the higher market value. The company's not buying the box back the stock here. That tender to the company choice is bait. I love it. I got to press pause on recording to fix some stuff. Well, that's awfully cocky, my friend, saying that you're already right. But you are right, so that's okay. We're going to have a little fun with this thing. Fair enough. Confidence can sound a lot like cockiness until the math checks out. Boom, correct one. Question number 3. No fucking around. Here we go. Which of the following securities is most appropriate for a customer of moderate means who wants to accumulate funds for future family college expenses? A, zero coupon bonds. B, bonds offering high yield to maturity. C, high quality bonds providing excellent liquidity. D, high premium bonds offering better than average current yields. Let's see what Mr. GPT says, or Miss GPT, whatever. I think it's a female voice when I play the voice. All right, let's think like a rep. High quality bonds. Let's see. So let's think like a rep who's actually listening. Moderate means in college savings means they want steady growth, no surprises, and liquidity if life hits back early. Now the choice is zero coupon bonds grow nicely, but no liquidity and phantom income every year. Not great for someone with moderate means. High yield bonds, junk territory, too risky. High premium bonds, better income, but not ideal for long-term accumulation. You're overpaying up front. High quality bonds with liquidity, safe, tradable, reliable, exactly what this client needs. Answer, high quality bonds providing excellent liquidity. Reasoning, when money's moderate and purpose is predictable, you don't gamble, you protect principal and keep options open. Now, I would like to challenge you on this, as FINRA usually loves zero coupons for college savings, and moderate means they probably won't have to worry about phantom tax, because considering 42% of households don't pay any federal tax, I think it's going to be zero coupon bonds, because that's kind of the way they lead all the time with FINRA. They love zero coupons for college savings. So let's see what they say. Excellent challenge, and you're absolutely right. That's the serious end mindset right there. Think like FINRA, not like a financial planner. Let's reframe. FINRA's logic, the question says accumulate funds. That's code for growth over time, not current income. Zero coupon bonds compound quietly, no reinvestment risk, and you know exactly what you have when the junior hits college age. And as you said, for moderate means, phantom income tax is likely not bite hard at all. Correct answer. So that's 2 and 2, baby. Correct. FINRA answers zero coupon bonds. Reasoning, FINRA's rule of thumb, zeros for future needs, especially education, because they're predictable, disciplined, and long-term growth vehicles. Liquidity be damned, they won't goal matching. So again, nice catch. You just saved me a suitability demerit. Let's take question number 4. So understand, that's where we are, okay? So hold on, we've done how many questions? 1, 2, 3, okay. According to them, they got 2 wrong. I'm going to say they've gotten 2 wrong, 1 right, okay. Now, this is why you have to challenge GPT all the time. You on all the AI, you can't always trust that they're always going to give the right answer. Even if they give an explanation, challenge it back. Now, I got to tell them, I think you have 1 correct, not 2 correct. We've only done 3 questions. Okay, boom. There you go. Love it. Okay, we're 1 and 2, baby. 1 and 2. We're going to get there. So far, not doing so great. Okay. Company XYZ, which is incorporated in New Jersey, plans to issue securities that will be offered in New Jersey, New York, and Connecticut. Registered reps from broker-dealer ABC will conduct sales in each of the aforementioned states. Which of the following statements is true? XYZ must satisfy blue sky laws in New Jersey, New York, and Connecticut. B, the RRs only need to be registered in New Jersey in order to sell the security in each of the states. ABC must maintain branch offices in New York, Connecticut in order to sell the new issue to those states. D, the new issue is only required to be registered in New Jersey as long as the prospectus states that the issue is available in New Jersey, Connecticut, and New York. So let's go, baby. Let's see what they say. Let's see. Oh, crap. Control Z, right? Control Z. I always do that all the time. Okay. Thank God for Control Z. Control V. Let's see what we say. The issue is based in New Jersey, but selling in 3 states. When a non-exempt security is offered in multiple states, it's subject to each state's blue sky laws, state registration. Now the choice is XYZ must satisfy blue sky laws. Yup, every state where the securities are sold must approve the registration or grant an exemption. RRs only need to be registered in New Jersey. Nope. RRs must be registered in every state where they sell. ABC must have a branch offices. Nope. No branch required. Registration of the reps is what matters. D, only required to register in New Jersey if prospectus says so. Total nonsense. The prospectus doesn't override state law. So the answer is A, XYZ must satisfy blue sky laws in New Jersey. Reasoning, every state with sales activity is jurisdiction. That's blue sky 101. FINRA doesn't care where the home office is. They care where the offer and sale happen. So we're back to 50-50. There we go. I'm going to do 1 more. Then I'm going to take a break and teach. We'll come back. You won't even notice. I might be wearing different clothes, but who knows? A 25-year-old customer opens a Roth IRA and makes the maximum annual contribution to the account. The customer has a long-term perspective, is not risk-averse, and might use the funds in the future as a down payment. Might. Which of the following investments is most appropriate for this customer? A Ginnie Mae mutual fund, a balance exchange traded fund, a floating rate bond, a tips. Let's see where we go. Let's see what GPT has to say. 25 years old, long time horizon, not risk averse, possible housing. Okay. Done someday, but still long term. Now the choice is Ginnie Mae fund, safe but income focused, not growth. Too conservative for a 25-year-old. Balance ETF, mix of stocks and bonds, decent, but a little too cautious for someone explicitly not risk averse. Floating rate, bond ETF, fixed income again, designed for interest rate protection, not long term. Tips, inflation hedge, super safe, not growth. So the one that fits the long horizon and willingness to take risk bet here is the balance ETF. But let's be clear, if this were a standard IRA, we might want 100% equities. However, since it's a Roth, long-term tax-free growth plus potential early withdrawal for home, the balance ETF gives solid growth and some stability if he pulls out some out for the house. Answer: balance exchange traded fund. Reasoning: a Roth IRA plus young plus long-term equity heavy but not reckless. The balance ETF gives diversification and flexibility if life shows up early. So 3 and 2 there. They broke 500. I love it. And I have to jump. I will be back, guys. I will be back. And we're back. Okay. Municipality XYZ is considering bringing a bond anticipation note ban offering to the market. Which of the following responses best describes the municipality's reasoning for issuing bans? Let me get it all in there. Okay. A, to attract customers subject to alternative minimum tax. B, to limit its balance sheet obligations solely to short-term debts. C, to pay down principal and outstanding bond issues, maintaining its current rating. D, to get a project underway to generate revenue before obtaining long-term financing. Let's go. What does GPT say? Bans are short-term securities issued by a municipality in anticipation of a future bond sale. They're like saying, we need to start building now. We'll pay it off once your real financing comes through. Let's check the choices. You guys can read this. I'm going to go through. Answer: to get a project underway to generate revenue. Let's go through all of them. Attract AMT customers. Nope. AMT applies to private purpose bonds, not bans. B, limit obligations to short-term debt, not the goal. That's just a feature. C, pay down principal and existing bonds. Nope. Bans raise new money, not retire old debt. D, get a project underway. Bingo. That's the whole point. Bans are the bridge loan of the muni world to get projects started, bring in some early revenue, and then roll it into a full bond issue. So 4 correct, 2 wrong, and RANDs do the same thing. Different reasoning, but that, boom, okay. Here we go. Oh, an option. A customer sells short 100 shares of ABC at 22 and simultaneously rates one ABC Gen 20 put at 1. At what price must the customer close out a short position to break even? A 19, B 21, C 22, D 23. Let's see how we do. I think they do well on the options. And drum roll, please. Okay. All right. Time to flex those options muscles. Short 100 at 22, right at 20, put at 1. Total credit 2,300. To break even, the short stock must be bought back for the same total amount of credit you took in, 2,300. 2,300 divided by 100 shares is 23. Answer is 23. Reasoning: you sold stock and collected premiums. That's your cushion. The stock can rise up to 23 before you start losing money. Short stock plus short put is a bearish position, and the break even's above the short sell price. They set it for the wrong reason, but short stock, short put is still bearish. Okay, good. Neutral, good stuff. They added that last bit in, that was not good. Okay, here we go. A company stock earns $55 per share, pays a quarterly dividend of 75 cents. If the current price of the stock is 75, at what multiple is the stock currently trading? Let's go. This one's just straight PE math, no tricks or traps. Formula: price divided by earnings per share, PE ratio. So 75 divided by 5 is 15. Answer is 15. Dividends don't factor into the PE. They're just how earnings are distributed. This stock selling at 15 times earnings, a nice middle of the road valuation, not Tesla level crazy. Boom, 6 in a row. Not 6 in a row, but 6 right, 2 wrong. Yeah, so if they say the word multiple, they mean PE. According to MSRB, the final responsibility for proper supervision of personnel engaged in activities involving municipal securities rests with which of the following entities? FINRA, MSRB, the Federal Reserve, or the dealer engaging in municipal securities activities. Let's see where we go. Easy one. This is a classic. Who enforces it? The MSRB writes the rules but don't enforce. At FINRA, the SEC bank regulators handle enforcement, but supervision of personnel, that's internal. The duty always falls on the dealer itself, meaning the firm employs the reps. Answer: the dealer engaging in municipal securities activities. Reasoning: the MSRB makes the rule book, but your firm is the one on the hook for making sure everyone follows it. Bottom line, you can't delegate blame up the food chain. And remember, no regulator ever approves anything ever. Onward. Okay. A customer has been approved for writing cover calls only. The customer insists that her register rep accept an order to write uncovered calls. The RR should take which of the following actions? Refuse to accept the order. A, accept the order and mark the target unsolicited. C, accept the order but send a new risk disclosure document. D, recommend to commit no more than 10 to 15% of the customer's investment assets into option strategies. And what do we go with? Okay, pure options compliance. FINRA doesn't play here. If a customer has been approved for cover calls only, uncovered calls are beyond their approval level. That's an uncovered option strategy, way higher risk. So even if the customer insists the RR cannot accept the order, marking it unsolicited doesn't make it illegal. Approval level still applies. Refuses to accept the order. Unsolicited doesn't override suitability or approval limits. You can't take an order a customer isn't approved for, period. The RR's job is to protect the firm and the client, even if the client's feeling bold. Now, here's the thing. This is where people get confused. If I give you an order to buy international buggy whips, as long as I'm allowed to do that, then you take the order, even if it's stupid. But as far as being approved to do this, cannot do it unless I'm approved. And who would approve this? Yes, the ROP. There's a nice long one. Customer purchased $100,000 of growth fund XYZ 9 months ago. The customer informs his registered rep that he wants to move 50 grand to a blue chip fund. The RR has a number of customers who will blue chip fund ABC. The RR should recommend that the customer A, exchange 50 grand into blue chip fund in the XYZ family of funds. B, purchase $50,000 blue chip fund ABC since the RR is familiar with the fund. C, delay any exchange within the family of funds until the next quarter to realize a breakpoint discount adjustment from the $100,000 level to the $50,000. D, redeem the $100,000 growth fund and purchase 50 grand of growth fund ABC and 50 grand of blue chip fund ABC in order to take advantage of the $100,000 breakpoint. That is a hell of a long question. Guys, work on it while GPT is working through it. And here's a set. This mutual fund switching question. FINRA loves testing the ethics of it. Here's a setup. Customers in growth XYZ wants to move 50K to a blue chip. RR knows blue chip fund ABC from another family. Now FINRA says, always stay within the family. Remember, I have videos on that. Always stay within the family. You never leave the family. Even if it meets the objective, that avoids unnecessary sales charges and potential violations. Exchange within the family, boom, best move. No new sales charge, fits the customer goal. B, blue chip ABC outside the family, likely new load, unsuitable. Delay for breakpoint, breakpoints apply to purposes, not switches, irrelevant. D, redeem all and split, that's churning territory. So the answer is A, keep it in the family. You always look for the most economical and suitable move. Same family means no new load and keeps the customer's investment objective aligned. FINRA loves that answer. He's on a roll. A customer informs his registered rep that he wants to sell 10 50 calls currently trading at 5 and buy 10 60 calls currently trading at 1. XYZ is currently trading at 52. By the expiration date, the customer wants XYZ to trade below 50, at 52, near 55, above 60. What do we got here? And what are we going to do with? All right, this one's vertical spread. Let's break it down. You know what it is. Sell 10, you collect 5, you buy 60 calls, you spend 1, net credit of 4 grand. That's income up front because this is a bearish position because you wanted to keep it. You want both calls to expire worthless, so you keep the credit. For that to happen, the stock must finish below the lowest strike by expiration. Answer is below 50. This trader is rooting against XYZ. It's a short credit call spread. Below 50, you keep the full 4K. Above 60, you're cooked. 10 in a row. 10 versus 2. Not bad, people. So again, below 50 is the answer. And if you can't do it, you can read it over here. A customer buys 100 shares of ABC stock at 45 a share and sells one ABC July 45 call for 2. If the customer is assigned when the stock price is 50, the resulting gross profit is 200, 500, 700, 1200. Guys, do it. GPT should get this one right. Buy at 45, that's your cost basis. Sell it at 45, call it 2, collect the premium. Stock called away at 45, since it's signed, you sell it at 45. So you bought it at 45, sold it at 45, no gain on the stock, right? You bought it at 45, sold it at 45, no gain. Plus you get the $200 premium. The answer is $200. The premium is your only profit when the strike equals your cost. If the stock runs to 50, too bad. You capped your upside when you wrote the call. Boom. I love this. Next, which of the following actions might diminish the quality of a municipal revenue bond? Pre-refunding, funding the sinking fund, issuing parity bonds, escrowing to maturity. That sounds dirty. Here we go. The weekends of claim. Let's run through it. Pre-refunding, that improves quality. Now you've got treasuries backing it. Funding the sinking fund, also positive. It strengthens the credit. Issuing parity bond, that's the one. Fire, baby. It adds more bonds backed by the same revenue stream, diluting coverage. D, escrowing to maturity, same as pre-refunding. That's an upgrade. So the answer is issuing parity bonds. More bonds against the same pot of money, weaker security for you. It's like giving more people access to the same paycheck. Everyone gets a little less coverage. So parity bonds are bad for the original bondholder because that means there's more people having the same access to that revenue stream that they're betting on. I love it. Ooh, here's a little math. Customer owns 4,700 shares of ABC, 5% cumulative preferred. Dividends are paid on a quarterly basis. ABC has not paid the dividend on these shares for the last 5 quarters, but is now profitable again. How much is ABC owed to the customer in back dividends? You have to pay attention. How much do they owe back? How much are they going to pay now? How much do they owe back dividends? 0, 29.37, 73.43, or 29.375. Let's see. Let's see if my buddy GPT can spill the tea. Okay. Step by step. Par value 25, dividend rate 5%. Annual dividend rate is $1.25 a year because it's 5% of 25. We're good with that. Quarterly dividend is $1.25 divided by 4. That's 31 and a quarter cents per quarter. They missed 5 quarters, so 5 times 31 and a quarter cents is $1.5625 times the number of shares 4,700, 73.4375. Cumulative means missed payments stack up. The company's got to make up those before paying any common dividends. I love that. That's awesome. I have to do one more before I jump into my live. Okay. A customer has a following position: long X1 XYZ, long 1 XYZ October 60 called 6, and short 1 XYZ October 50 called 10. This position is considered bearish, bullish, neutral, diagonal. The code: long a call, right to buy at 60, short a call at 10, obligation to sell at 50. Same expiration. So this is a vertical spread, specifically a credit call spread. You took in $4 credit, right? You took in money. Credit call spreads are bearish. You want the stock to stay below the lowest strike, so both calls expire worthless and you keep the premium. The answer is bearish. Reasoning: you're short the lower strike, long the higher. You profit if the stock drops or stays put. A credit call spread always bets against the stock. Boom. This person's on a roll. Another option question. We're just challenging it. A customer is long XYZ Gen 35 call and long a 35 put. The customer paid a premium of 2 for the call and 4 for the put. Which of the following statements is true regarding the strategy? The strategy is called the bull credit spread. The customer is anticipating volatility. The customer will profit if XYZ closes at 35. At expiration, the customer will break even if the XYZ trades at 37. Let's do it. Let's do it, baby. Do it. Do. A longer call and longer put on the same stock, same strike, same expiration. That's a textbook long straddle. Let's break it down. Long 35 call 2, long 35 put at 2, at 4, total cost 6. Now the goal: you make money if the stock moves big up or down. You lose it if it just sits there. Break evens are 35 plus 6 and 35 minus 6. It's 41 and 29. So you want volatility, not stability. The customer is anticipating volatility in XYZ. Long straddle: move, baby, move. Doesn't matter which way, just not sideways. Okay. We need to kick its ass here. Oh, here's one. This is a nice long one. An existing customer refers his retired mother to his registered rep. I think I can finish this in time. In order, investor approaches the sale of her home, approximately 200 grand. The son believes she is a conservative investor and needs to live on the income from these funds for the rest of her life. After speaking to the mother, the RR discovers that the mother has several annuities and is collecting Social Security as well as a pension. She invested heavily in the markets when she was working and is quite sophisticated. Her cash flow is well in excess of what she needs to live on. She also states that she would like to grow the funds from the sale of her home as a legacy for her grandchildren. In which of the following portfolios is it most appropriate for her to invest the house proceeds? Long-term carry annuity with a lifetime income rider, zero coupon bonds maturing in 9 years and yielding 3%, an open-end fund that invests primarily in distressed debt, a closed-end equity trust with a long-term growth. Let's see what it says. See if it catches the twist. Oh, it caught it. This one's a suitability curveball. Classic FINRA trap where the son's view doesn't match the mother's actual profile. It picked it up. Let's summarize. She's retired, yes, but already has income, cash flow exceeds needs, sophisticated investor, goal, long-term growth, and legacy. Now the choices: long-term care annuity with income rider. Nope, she doesn't need more income. Zero coupon bonds, too conservative, not growth oriented. Remember, grandma's a baller. Okay. Distressed debt fund, too risky, not that much of a baller. Speculative and inappropriate, even for a sophisticated retiree. D, closed-end equity trust fund. That's the one. Equity-based, long horizon, and fits your objective of growing equity. So the answer is a closed-end equity trust with long-term growth as its primary objective. Don't get distracted by your age. Suitability is about objectives, resources, and risk tolerance, not birth year. She's got income handled. Growth is a goal. Okay, I'll be back in a bit. Okay, here we go. Next one. In October, a customer wants to write calls for a maximum of 6 months against his 5,000 share position in ABC to generate income. The customer wants to avoid tax liability in the current calendar year. Which of the following option strategies will maximize the customer's income? American style options, exercise month in April, out of the money, who cares? American style expiration in January, European style expiration in December, European style expiration in April. Remember, American style is freedom, baby. You can exercise anytime you want, and European is very communist. You can only exercise at expiration. Let's see how GPT handles it. It's a sneaky combo. Let's unpack it. Let's see. I like it. Okay. It's October. It's do with the deals. It's October, and the client wants income premiums, but no tax hit this year. Income from writing options is not taxable until the position is closed. That means exercise expired or bought back. So if he writes an option that can't be exercised this year, he pushes the tax event to next year. So American style can be exercised anytime, means the tax event could happen this year, not what I want. European style can only be exercised at expiration. Perfect. No chance of early assignment. Expiration in April next year fits the max 6 months window and ensures the event lands in the next year. And since he wants maximum income, that means the in the money calls doesn't matter. It's going to matter because everything exercising European in April is the only one that works. The other three. So that's what they said. European style locks the tax event into next year, and in the money brings in the fattest premium. Mission accomplished. Not that it matters. The in the money, out of the money in this case does not matter, unless this also said, if this one said expiration month April also, then you would take the in the money because you get a better premium for in the money options. Good stuff. It's doing well. Still made a couple mistakes in the beginning. You got to correct them. Slap that pitch down. Here we go. A customer instructs his register rep to purchase 100 shares of ABC at the market. The RR mistakenly reports to the customer that he purchased the shares at a price of 20 when the actual execution was 20.02. Which of the following statements is true? A, customers owed a better execution price. Customer is permitted to decline the execution. The customer must accept the price at which the shares actually traded. And D, the customer is permitted to take only the amount of shares that equal the total dollar amount in the original report. Here we go. This one's about trade reporting errors. And FINRA's rule is clear. The firm is bound by the actual execution price, not the mistaken verbal quote. Here's what happened. The RR said 20 bucks, but the trade actually happened at 20.02. The customer doesn't get to reject it or demand the reported price. The only binding number is a true execution price. The true price. Truth will set you free. The customer must accept the price at which they traded at. The reason the report was an honest error. The trade stands as executed. If it were the firm's fault in execution, like screwing up a limit order, that's different, but misreporting isn't a get out of trade free card. Boom. The answer is customers must accept. Love it. Onward. When earnings per share are reported on a primary basis, the calculation is based on A, common shares outstanding plus potential dilution of other shit, number of shares outstanding, continuing operations and extraordinary charges, common shares outstanding less newly issued shares during the year. This shouldn't be so bad. This should be an easy one for them. This is all about EPS terminology. When a company reports primary EPS, that's the basic version before considering any potential dilution. Once they include convertible bonds, preferred warrants, that's fully diluted. There we go. Primary is basic net income available to common divided by the weighted average common shares outstanding. No convertibles, no options, no extras. So this is the number of shares outstanding. So again, first of all, reasoning, primary means plain vanilla, just the current shares. Fully diluted is when you toss in the what ifs. Okay, so we got this right. The answer is number of outstanding shares. So primary means basic, just that. Fully diluted means we also include all the possible conversion of convertible bonds, rights, and warrants that would increase the number of shares because they are dilutive. And if you don't know what dilutive means, it means if you get diluted, that means your ownership goes down. Kind of like when you put a drink in a glass and you throw some ice in there. If you wait too long, that shit gets diluted. Okay. The systematic withdrawal plan offered as a mutual fund service will have which of the following characteristics? The plan may result in depletion of capital. The withdrawals may not exceed dividend payments. The cost basis of the shares will determine the amount of the monthly check. The charge for this service is usually the same as a sales charge when purchasing the fund. So let's see what Jippet says. Understanding of systematic withdrawals. Here's what's true. The investor gets regular payments, often monthly or quarterly. The fund redeems shares to make those payments. If withdrawals exceed what the account earns, it eats into the principal. That's the key phrase. Now the choices. A, may result in depletion of capital. That's exactly what can happen because if you take out more than what you earn, you're cutting into the capital. Always remember what rich people say, never touch the principal because once you do, it's gone. Withdrawals may not exceed dividend payments. They can. That's the whole point. You want dividend payments to exceed the withdrawals. The earnings. Cost basis determines the check amount. Payments come from a chosen schedule, not basis. And charge, it means same as sales charge. No, it's not a service. It's not a new purchase. So the plan may result in depletion of capital. Systematic withdrawal, steady income. But if you take up more than you earn, you're just slowly selling yourself out of the market. So a systematic withdrawal plan, say you have $1 million. You say you're going to take out 4% a year. That's 40 grand a year. As long as your fund or your portfolio earns more than 4%, you're fine after taxes. If it earns less than 4%, you're going to eat into the principal, which means you could lose your money. Here we go. Which of the following is a factor in the credit analysis of a general obligation bond? Flow of funds, feasibility, rate covenant, or population trends? It's getting late, so I'm going to start speeding up a little bit. GO bonds are backed by the full faith and credit taxing power of the municipality, not revenues from a project. So analysts look at the city's economic health, not cash flow. So let's take each choice. Flow of funds is a revenue. Feasibility, revenue. Rate covenant, revenue. Population trends is all about the GOs. That's a big part of GO analysis. More people is a broader tax base equals stronger credits. Remember, like if people are moving in, it's better. If people moving out, it's worse. That's why you have to see what happens with this mayor's race tomorrow. Will people leave? Reasoning GO equals taxes, demographics, and economic vitality. Revenue equals user fees, project cash flow. Keep that split burning into memory. Okay. So again, it's population trends. D onward. Okay, here we go. Let's see if we can challenge me here with this one. I'll read it. Let me get it in here first. A 45-year-old man making $150 a year and a 401k plan is changing employment. And has a 401k plan is changing employment. The new company has no retirement plan, but will also pay him $150 grand a year. What should the RR advise the client to do? A, continue his contributions into his 401k. B, roll his 401k into a Roth and continue his contributions. C, roll his 401k into an IRA and continue. D, take a 401k distribution and buy a variable. I think they'll get it right. Give me 22 in a row. 22. Facts. 45-year-old not near retirement. 2, has an existing 401k, but job doesn't offer one. Still earning $150 grand a year, so we can afford to keep saving. A, Continue contributing. Oh my God, I can't speak. Continue contributing to his old 401k. Not allowed because once you leave, that's done. So A is out. B, roll to the Roth. That'd trigger tax on the entire rollover. Big mistake. And he might be making too much money to put into it. So that's out. Roll to a traditional, keep contributing here. Perfect. Keeps the tax deferral going, no penalties, and he can still add up IRA limits. D, take distribution and buy an annuity. That's a taxable distribution plus a 10% penalty because he's under 59 and a half. That's brutal. The answer is C, roll his 401k into an IRA and continuous contributions to the IRA. You'll absolutely get questions like this on the test. So there's two reasons you don't do the Roth. One, because you pay taxes on this shit. And two, you can't put money in. If he's making 150, he might be priced out of it. Ambac Insurance guarantees the time of payment of interest only, principal only, interest and principal, sinking fund deposits. I tried to put a lot of munis in here if I could. Okay, Ambac, American Municipal Bond Insurance Corporation, and the other insurance like MBIA guarantee both parts of bond's payment promise. So the answer is interest and principal. The reasoning, bond insurance doesn't mess around. It guarantees full on-time payments of both interest and principal, even if the issuer defaults. That's why insured munis carry higher ratings. Because remember, insurance only covers the interest or principal. If you pay the premium, you're not getting that money. You'll just pay the principal. Oh, imagine. Let's see if they can do it better than me. Put it in here. As an initial transaction in a margin account, a client buys 500 shares of XYZ at 40 and meets the Reg T requirement. The next day, the stock rises to 44 and 3 days later drops to 38. What is a client's equity in SMA? A, 9 grand equity, 0 SMA. B, 9 grand equity, 1,000 SMA. C, 12 grand equity, 0 SMA. D, 12 grand equity, 1,000 SMA. Let's see what they do. This might take a bit. Let's see what they say. I want to see what they. I love it. That is outstanding. I freaking got it right. Okay. I can't beat this stupid thing. Initial purchase is 500 at 40. That's 20 grand total position. Right T is 50%. You deposit 10, you borrow 10. Debit is 10, equity is 10. Stock rises to 44, and you can read this. Well, let's make it bigger too so you can read it all right. Okay. Stock market values. Now the stock rises to 44. 500 times 44 is 22 grand. 22,000 minus 10 grand is 12 grand, or equity is 12. SMA increases. So then we go. So what's our equity? It's equity minus rate T. So 12 grand. They just said the equity went up, you get 50% of it, which makes sense. If you're so remember, what it's saying is that if you're in a normal account, if the stock goes up, your SMA is half your equity, what it grows. So if your equity goes up 3 grand, it's up, SMA is up 15. In this case, the equity went up 2 grand, you go up 50%, which is 1,000. So now we have 1,000 in SMA, 12 grand in equity. However, then the stock dropped, which is the way it works for me. Market value now is 500 times 38, which is only 19 grand. Equity is only 9 grand, 19 minus 10. SMA is still 1,000 because you remember you have to use it to lose it. SMA doesn't decrease unless used. It's like a one-way valve. Answer is B, 9 grand equity, 1,000 SMA. Reasoning, equity moves with the market, but SMA only grows when you gain, not when you lose. Once created, it sticks until it's used. It's doing well. It's doing well. The current quote on XYZ is 1520 by 1540. Your customer wants to enter a limit order to buy a 15 to 11. As a register rep, what should you do? A, reject. B, place the order with the ATS. That's like an ECN, among other things. C, enter the order with the stock exchange. Place the order with an ECN. Let's see what they say. If they get this right, we're cooked. Let's walk through it carefully. The purchase. Oh, I just did the same thing. Never mind. We got that. Hold on. See what happens. Hold on. I'm going to stop us for a second. Okay. I just had to fix it. If you look, I put the same thing in twice, just so you know I'm not doing anything crazy. Here we go. Okay. Stocks in the U.S. stock exchange are quoted in pennies to the nearest penny, not in thousands like 15 to 11. So this means an order at 15 to 11 is not a valid price increment for listed or NASDAQ stocks. A, answer is A, reject the order. Market trades in 1 cent increments. The RR can't enter an order with more decimal places, so it must be rounded to 1521 or 1522 before entry. So you're rejecting it. You can't do that. They don't have amended. So you have to pick the best answer. The other ones don't work. You got to reject it. So what would normally happen is you would say, hey, I can't do it at 2111. I'll just put in a 21 or 21.1. You say I'll put it in 21 and they'll go fine. Okay, here we go. A margin account has the following balances. Long market value 20, short market value 30, credit 48, debit 8. What's the account to SMA? Let's go. Let's see how it does. All right, margin mix time. Let's line it up. Long side is LMV 20, debit 8, equities 12 grand. Short side 30, credit 48, SMV 30. You subtract 48 minus 30 is 18 grand. So the total equity is 30 grand. That's the one way to do it. SMA is the excess equity above right T. So right T of the long is 10. The right T of the short is 15. Remember, half the market value. Total right T requirement is 25 grand. Your equity is 30. 30 minus 25 is 5. SMA is 5 grand. SMA reflects the extra buying power created by the equity above right T. Here you got 5K more than required, sitting as potential leverage. Leverage. Spending as potential leverage. Okay, here we go. We're past halfway, people. What risk should an investor in an ETF consider that would not be associated with an ETF? Credit, liquidity, market, or volatility. Baby. Here we go. Okay, here's the difference. ETFs hold actual assets, stock, bonds, and commodities. ETNs are unsecured debt obligations of the issuer. That means if the issuer goes under, you're just another creditor. ETFs don't have that problem because the assets are held in trust. A, credit risk. Boom, that's the answer. ETNs have credit risk, ETFs don't. ETNs carry issuer credit risk since they're structured notes, not ownership of a basket. The rest, liquidity, market, volatility, apply to both. It is doing really well. We should be embarrassed that this could pass it. Here we go. The president, I'll change that, of a public company during an interview inadvertently discloses, that's really yes one, it just jumped, huh? Material non-public information. Which of the following action must be taken? Actions. 1, must immediately release the information to the media. 2, must file a 10Q. 3, must file a 10K. 4, must file an 8K. Here we go. Let's see how it does. See if we can handle the Roman numeral shit. Reg FD, fair disclosure. When a company accidentally leaks material non-public info, they've got to make it right, make it public immediately to the level of the playing field. That means immediate media release, format file AK. That's how you remember. So immediate, put it out on Twitter, whatever you want. Then file AK. That's how you formally disclose material events. 10Q is quarterly, 10K is annual. That's not the same thing. So the answer is 1 and 4. Boom. Reg FD says if you blow it and leak the material, you fix it fast. Same day public disclosure and an 8K filing keeps everyone equal. No insider advantage. A 60-year-old man, quite young, whose investment objectives are income and capital gains, wants an investment that can allow for liquidity during the trading day, would be best advised to invest in which of the following? I hated this question because I don't love it, because the answer that I like, the answer that I want is not there, but you got to pick the one that you come with. Okay. Age 60 wants some income and growth, not speculation. Objective, income and capital gains needs a mix of yield and appreciation potential. Liquidity, specifically wants to trade during the day. So that knocks out anything that trades as once. So mutual funds trade once a day, out. UITs trade once a day. It's not actively traded, so it's a fixed portfolio. ETNs trade intraday too, but usually tracks exotic stuff and adds credit risk. Not ideal for a 60-year-old seeking stable income. ETF trades intraday, offers income via dividends and growth potential. The answer is ETF. ETFs are the sweet spot, income growth, and you can get in or out anytime during the day. Perfect fit for the man's goals. Which of the following positions would be profitable in a bear market? Debit call spread, credit call spread, debit put spread, credit put spread. Here we go, baby. These will help you. This is how they could be asking it on the test. Straight options. Line up the things. Debit call spread, bullish, out. Credit call spread, bearish. Good. Debit put spread, bearish. Credit put spread, bullish. So it's going to be 2 and 3. Boom. Letter B. Bears love credit call spreads and debit put spreads. Both profit when prices fall. Everything else gets hurt when the market slides. Okay. That's a good one. We got it. So remember, change. I'm just going to have my own shit into here. Change the word debit to buy. Okay. Buy a call, bullish. Sell a credit, sell. Debit is buy, credit is sell. So if you see debit, put the word buy in there. Buy call is bullish. Buy put is bearish. Okay. Credit is sell. So credit call is bearish. Credit put is bullish. A client has long 100 shares of stock purchased 2 years ago for 12.5. Over the 2 years, he has written call options for premiums of 1,500, which expired. What's the cost basis? 11 grand, 12.5, 14,000 cannot be determined. He's long 100 shares, bought at 12.5, and he's written covered calls that expired worthless. Those premiums are short-term gains, but they do not adjust the stock cost basis. They're separate taxable events. The answer is 12.5. The stock's cost basis is what he paid for it. Expired call premiums are just gravy, extra income, not a change in basis. Remember, there are 3 things that don't affect cost basis: covered calls, accrued interest, and dividends. Okay, good stuff. Ooh, a client owns 500 shares of common stock of a company with 5,000 shares outstanding. The company is offering 1,000,000 shares through a rights offering. Which 2 of the following are true? He will receive 100 rights. He will receive 500 rights. He may buy 100 shares. He may buy 500 shares. Let's see if we can get off this track of the GPT kicking the shit out of our test. Company has 5,000 shares outstanding. 1,000,000 shares offered. 5,000,000 shares outstanding, 1,000,000 offered. 1 new share for every 5 old shares. So we get 5. You get 5 rights equals 1 new share. That's fair. 5 divided by 1. Okay. Your client owns 500 shares, so we get 500 rights. That's easy. Now divide those 5 rights by the new shares. 5 divided by 5, 100 new. 2 and 3. Rights are issued, 1 per share owned. 5 rights equals 1 new share, means 500 rights. Let's him buy 100 shares. Boom. I've done this on my tricky one. You can see this version, but that's awesome. An aunt who wants to establish an educational account for her niece, which also gives the niece control over the assets at a certain age, would be advised to use A, UTMA, B, Coverdell, C, 529, D, trust account. Let's line up the options. 529, playing great for education, but the donor retains control. Beneficiary never automatically gets control. Coverdell, ESA, same deal for education, but the beneficiary doesn't gain control, plus it phases out at higher incomes. Trust account, you can structure control, but that's legal heavy, not the simple go-to. Yutma, perfect fit for a minor, control by custodian until the child reaches an age of majority, then full control passes. I'm going to challenge this one. So they're saying Utma. I think it's a covered up. Let's see. It specifically says education account. And I thought Coverdell, the kid gets when they turn 18. Let's see what they say. Okay. Okay. Excellent catch. Of course, Ken. You're the best. Okay. You're absolutely right to pause on that phrasing. Let's dissect it carefully. The question says an aunt wants to establish an educational account for her niece, which also gives Coverdell ESA, especially for education. Yes. Funds must be used for qualified education expenses. Ownership, the custodian controls it until the beneficiary reaches age of 18 or 21, depending, at which point the control passes the beneficiary. That fits the educational part and the control at a certain age part. UTMA can be used for education, but it's not an educational account. Funds can be spent on anything for the child's benefit. So the key phrase educational tips it to Coverdell, not UTMA. Boom. Okay. So retired answers B. Boom. Love it. Okay. Good stuff. I love it. Boom, boom, boom. They corrected it to 32 right, 3 wrong. Coverdell is explicitly for education and eventually give the Child control, usually at 18 or 21, depending on the state. UTMA fits the control part, but not the educational account. Boom. I think it's 18 no matter what. I'm not going to look it up. It doesn't matter. Oh, here we go. Good. So we still doing well. It's still in the pretty high range here. And see, it doesn't get mad when you're corrected. It just goes back. You have to be like that. No ego, baby. Here we go. A client owns 10,000 of an inverse ETF. If the underlying index declines by 10 and rises by 5, the value of the client's position is 1045, 945, 1055, 1155. Let's go, baby. It's thinking. Inverse ETF. Okay, start at 10 grand. The index declines 10. The inverse goes up 10 from 10 grand plus 10% is 11 grand. So we're now at 11. Next, the index rises 5%. The inverse falls 5%. 5% of 11 grand is 1045, is 550. So we're going to go down to 10450. The answer is A, 10,450. Reasoning: inverse ETFs move opposite their index daily, and the compounding causes small tracking differences over time. But in this simple two-tip example, you're up 4.5% total. Boom. A self-employed person making 95 grand wants to contribute to the highest dollar amount in a retirement account would be advised to use Roth, traditional, SEP, or simple. And I think when I looked at this one, when I took it, I think I got it wrong at first. Okay, here we go. Here's the breakdown. Roth, traditional, both cap out at 7 grand, 8 grand if you're old like me, way too low. Simple IRA, higher still about 16 to 17 range plus small catch up. SEP IRA, the big gun, contribute up to 25% of net self-employment income, roughly 20%. After it's capped around 69 grand, so they're going to say SEP IRA. Did we cover all four? Yeah, okay. I'm going to just double check one thing. I just wanted to see the max contribution for a simple IRA. And there it was. It was good. We're good. Okay. I think we're fine. Okay. Good stuff. So they're right. SEP IRA, because you can put up to like 69, 70,000. Okay. A lot of old people on this. A 65-year-old man wants to continue to work and make contributions to a retirement plan past 70 and not required to take distributions would be advised to use which of the following: traditional IRA, Roth IRA, 403B, or trust account. Let's find out. Dun, dun, dun. Here's the deal. Traditional IRA, you can contribute to while working after 73, but it's fine. See, they take the old rules. Okay. 403B, also subject to RMDs at 73 unless you're working for that employer. But if he changes jobs, the clock starts. Trust account, not a retirement plan. Roth IRA, you can keep contributing at any age as long as you have earned income. And there are no RMDs during your lifetime. So the answer is B as in boy. Okay. Boom, we're killing it. I'm not killing it. They're killing it. Good stuff. RR wants to speak to a group of clients about a private placement in a 2-year-old company. The invited clients have a stated minimum net worth of $1 million, so they're good. The company's business is a refurbishment of medical equipment in hospitals. In the PPM, the company states that the investors are expected to receive a 15% annual cash dividend and can enjoy capital appreciation. What should the rep do before offering the security? A, nothing, because they all receive protection under the anti-fraud rule, 10b-5, under USA. Under Act of 34. Nothing, because all the investors are accredited under Reg D and the Securities Act of 33. C, the registrar rep should review the revenue and expenses as detailed in the PPM to see if it is feasible for the company to pay a 15% dividend. And the registrar rep must get a signed attestation from each attendee that they received the PPM. Let's see. I have a feeling I know where this is going, but let's see if they get it. It's a private placement, exempt from registration under Reg D. The investors are accredited, net worth $1 million, because remember, 1, 2, 3 accredited. The PPM promise is 15% annual dividend and potential capital appreciation. Sounds aggressive. Even though it's a Reg D and the investors are accredited, that doesn't let the RR off the hook. FINRA expects reasonable basis suitability, meaning the RR must actually understand and evaluate the deal's economics. Can this company realistically pay what it's claiming? Answer is C. The register rep should review the revenue and expenses as detailed in the PPM to see if it's feasible for the company to pay the dividend. Accredited investors are on a free pass to rip them off. The rep still has to perform, I added the rip off part. The rep still needs to perform due diligence to ensure the recommendation is reasonable and suitable. Reviewing the issuer's financials is part of that. So as an RR, just because you're rich doesn't mean you get to rip them off. If you want to, but you can't. Okay. In April, customer writes 1 October 70 put for 5. Later, the option is exercised. In October, the customer sells 100 shares of XYZ at 72. What is her profit or loss? 500, 700, 300, or no gain or loss? Okay, opening position. Sold a 70, put at 5, collected 500 premium. That's income. The put is exercised. When exercised, the writers buy the 100 shares at 70, buy the head 70, 7 grand outlay. We already received 500 premium, so net cost is 6,500. She sells the stock at 72. What is it? Sells the stock for 72, bought effectively for 65, profit 700. The answer is 700. The premium lowers your cost basis. You're signed at 70, sell at 72. That's 200 gain plus the 500 premium, 7 a share times 700 profits. Let me see if I do that. 65. Yeah, works. I love it. So the 700 premium, B. Which of the following would affect a portfolio's alpha? Adding more stocks to the portfolio, reducing the number of stocks in the portfolio, change in management, investing in real estate investment trusts. Let's see where we go with this. This is alpha. Adding or reducing stocks affects diversification, not alpha. Fair. Investing in REITs changes the asset mix, not the manager's skill-based return. That's giving an idea. Change in management. Absolutely. Alpha reflects manager performance. A new manager with different skill or strategy can change alpha. The answer is C, change in management. Alpha is manager mojo. New manager, new alpha, for better or worse. Diversification changes volatility. Beta, not alpha. I love it. Okay. It's doing well. If 50-year-old man contributes 25 grand to a non-tax qualified annuity, at 56, the value of the account is 40 grand and he withdraws 10 grand. If he's in the 28% tax bracket, he would owe 0, 15, 28, 38. Let's see if they catch it. Oh, sorry. Thank you. Why'd that happen? It caught it. See, it really caught it. Okay, here we go. There we go. Glad it caught itself this time. It does learn. Original investment, 25 grand cost basis. Current value, 40, earnings 15. When he withdraws 10 grand, under LIFO rules, earnings come out first. Remember, under basically any retirement account, non-qualified is going to be LIFO. So the entire 10 grand withdrawal is taxed at ordinary income. He's under 59 and a half. So we tack on the 10% early withdrawal because it's premature. I'll leave it at that. You never want to pull out early. Tax owed, income tax, 28% of 10 grand is 2,800 plus 10% equals 3,800. Non-qualified reasoning, non-qualified annuities go tax deferred, but withdrawals are taxed as ordinary income on the gain portion. And before 59 and a half, you get whacked with the 10% penalty. Get whacked. And what I'm going to do is I think I'll do the 50 here, and then I'll do another 50 in a couple of weeks with Perplexity or Grok. See what they do. See how they do. So far, I think he can't fail. Even if he got the rest of them wrong, I don't think he can fail. I call it a he. My wife says a she. A young couple in a low tax bracket with 2 young children want to save for their college education. What would you recommend? Sounds like one of the early ones. T-bill, growth funds, muni bond fund with 20 years to maturity. Let's see how we go. Here we go. Young couple, long time horizon, low tax bracket, don't need tax-free income. T-bill, safe but short-term, out. Growth funds designed for long-term capital appreciation, perfect for college savings because they're young. Muni bond, money bond funds, tax-free income isn't useful in low tax bracket and they're income-oriented and not growth-focused. So growth funds. Low tax bracket means skip tax-exempt income. Young with time means chase growth. Stocks and equity funds build that college fund faster over 10 to 15 plus years. Remember, rich people buy munis, poor people buy corporates. These are low tax bracket, poor people, they're doing the corporates, baby. Okay. Here we go. What is the loan value of a put option with 9 months expiration? 0, 25, 30, or 50. By the way, in case you didn't know, I said it, the last one was growth. We get near the end, babies. Here's a listed options cannot be purchased on margin. They must be paid in full. Because of that, they also have no loan value, regardless of how much time you're paying on expiration. The answer is 0. Now, options are sold 100% cash instruments. You can't borrow against them. You can't margin them, even with 9 months left. Now, here's the thing. If you buy a leap and it's more than 9 months out, you can do some margin as a loan value. You have to have 75% down versus 25 borrow. But once it gets within 9 months, you got to put up the rest. A boom, 41, right? So the answer is 0. Okay. Put it in here, make sure it's right. Okay. A U.S. company is selling 25,000 recycling containers to a Canadian company. That wouldn't happen in 2025, I guess, right? And will be paid in Canadian dollars. The best way for it to hedge a falling Canadian dollar would be to sell Canadian dollars, buy Canadian dollar calls, sell Canadian dollar puts, buy Canadian dollar puts. Let's see. Classic currency hedging. The U.S. exporter is getting paid in Canadian dollars. If the Canadian dollar falls, they convert back to, so if they convert back to US dollars, they receive less money. So they need protection against the Canadian dollar dropping. To protect against currency decline, you buy puts on that currency, buy Canadian dollar puts. A put on the Canadian dollar goes up in value if the Canadian dollar weakens, offsetting the loss in the payment's value when converted to USD. Straightforward hedge move. Remember, Epic exporter, they're selling recycling to Canadian, exporters by puts, importers by calls, because exporters absolutely are worried that the foreign currency will drop and they will not get as much. People won't buy as much stuff. And an importer is called because of where the foreign currency will go up. I love it. It's getting late. A young, aggressive investor with 80 grand net worth has been recently laid off, but has received a severance package for 3 times his annual salary and full medical benefits. What should the IRA do? A, discuss with the client whether there's a need to change objectives, change the objective of the account to income, change the objective of the account to moderate growth. Do nada. Here's a setup. Young, aggressive, long time horizon. Laid off, has 3 years of severance, full benefits, not a bad deal. No immediate income crisis. Still a major life change, triggers a suitability review. So you don't automatically change. That's presumptive. You don't do nothing because circumstances change. You discuss whether the objective should change based on the situation. Whenever you see something happening with a client, you don't automatically change anything. You just say, do we need to change it? Discuss with the client whether there's a need to change objectives. So the answer is discuss with the client. The rep's job is to reassess, not to assume. FINRA wants you to confirm whether aggressive growth still fits before taking any action. Suitability is a living conversation. Oh, here we go. An investor has 23,687, quite specific, in mutual funds and wants to invest an additional dose grant. The funds have the following breakpoints: 1,000 to 24.99, 5.5, 25 to 49.99, 5.25. What will be the sales charge? Now, this could end up being formatted bad, so we'll see if it works. Watch, it'll nail it anyway. Okay. Wow. Current holding 23,687. New investment 2 grand. Total 25 and change. That pushes the investor just over the 25 grand, so they qualify for a 5.25 breakpoint. Figure out how much of the 2 grand goes to the sales charge. Remember, so they're over, they get the breakpoint. Okay. So 2 grand. So they sales. So 2 grand, 5.25. 2,000 times 5.25 is 105. The answer is 105. Because the new purchase brings the total above 25 grand, the lower breakpoint applies to the entire purchase. Always check for breakpoints before confirming the order. A good register rep saves their clients a few bucks and earns trust. Okay. If the Federal Reserve is concerned about inflationary pressure, they could take which of the following actions? I wasn't sure I was going to put this one in there. Reduce the discount rate, reduce the money velocity, increase the reserve requirements, buy securities in the open market. Here we go. Monetary Policy 101. If the Fed's worried about inflation, that means the economy is running too hot, too much money chasing too few goods. Let's look at the tools. Reduce the discount rate, eases credit, stimulative. That's out. Reduce money velocity, can't be done by the Fed. C, increase the reserve requirements, reduces how much banks can lend, contracts the money supply, cools inflation. That might be the answer. Buy securities in the open market, injects money, stimulative. So the answer is C, increase the reserve, because if you reduce the discount rate, it's easier to lend. Money velocity is not our thing. Reserve requirement makes banks have to have more money on deposit, which reduces what they can lend. And D, buy securities in the open market. So the answer is C, increase reserve requirements. And the Fed wants it to fight inflation. It tightens higher reserve requirements, higher rates, or selling treasuries, all pull cash out of circulation. We're getting near the end. A 25-year-old has $5,000 to invest. He's in a low-income tax bracket due to recently starting a new business. Which of the following would you recommend? Traditional, simple, Roth, Roth 401k or Roth IRA? $25 long time horizon, no tax bracket, not getting much benefit from deductions, self-employed, has earned income, contribute to personal retirement accounts. Now the logic. Traditional IRA gives a deduction now, but that's wasted in low bracket. Simple IRA only makes sense if he's setting up a plan for employees, overkill for $5,000. Roth 401k, great for long-term tax-free growth, but usually tied to employer plan, not applicable unless he sets up one and it's expensive. Roth IRA, best fit, pay taxes now while low, get tax-free growth for decades, perfect for a young entrepreneur. Roth IRA. Roth IRA gives him tax-free compounding for life, and since his income's low now, he's paying taxes at a discount. That's a no-brainer at 25. This is the last one, peoples. Which of the following underwriting commitments has the greatest risk to underwriters? Best efforts, all or none, standby, or firm? There's two answers here that could be right, but there's one that's better. See if they grab it. Here's a lineup from least to most risk for underwriters. Best efforts, underwriters just try to sell. Unsold shares go back to the issuer, minimal risk. All or none, if the deal doesn't fully sell, it's canceled, still low risk for underwriters. Standby, underwriter agrees to buy leftover shares after a rights offering, some risk, but it's limited. The reason it's some risk is because the shares are already trading. They know it's trading. They're probably not going to lose their money. They'll probably sell it for about what they paid for it. Firm commitment, underwriter buys the entire issue and resells it, meaning they own any unsold shares. That's fully risk. Firm commitment's the answer. Firm commitment, we'll buy it all, sell what we can. If the market tanks, they're holding the bag. That's as risky as it gets for an underwriter. So 47, 43, not bad. Okay, let me tell him that's it. That's it. How did we do? Total questions 50, 47 right, incorrect 3. That's a 95% score, comfortably above the passing, even for a tough FINRA set. Breakdown by category. I like this. Options and margin, flawless. Municipals and suitability, rock solid, just missed one early call on the zero coupon. Retirement and taxation, clean all the way through. Regs and market mechanics, textbook perfect. If this had been an actual Series 7 section exam, that'd land squarely in the top 10% of test taker territory. Want me to give you a quick topic by topic summary of which areas you aced and which ones FINRA would likely hit again on a retake, your pressure points? No, I think we're good. I think you did so well. How are you going to do that? Okay. Not so bad. I think that was pretty good. I think that works. Okay. Everyone, thanks for joining in. Remember, every Tuesday and Thursday, I do a live. If this is for FINRA, remember, I do Tuesdays at 8 p.m., my live Q&A, free from 8 p.m. to 9 p.m. And what I do is now we're going to start doing a membership class after. My membership class is going to move to after my live on Tuesday nights, and we're going to get it done. Okay, everyone, y'all have a good night.